part of that. Let me go ahead and get this started on the recording then. This is Ken at Tortoise Capital. It's the morning Q&A, Saturday morning coffee talk with the gang. And we were talking about Sandy Munro discussing how Elon Musk uses The Art of War by Sun Tzu and put it in terms of battery day at Tesla. And although it wasn't the solid state battery, that's the game changer, according to Sandy Munro. The solid state battery is the end of the internal combustion and fossil fuel. That's the technology that changes everything. Now, the battery day, Tesla did not announce the solid state battery, but what they got was a 50% improvement in the battery technology that they have. And what they're essentially doing is they have a little battery pack assembly where they got a bunch of almost like small D cells in there. And so they pack those up and they put all that in a battery case, and then they attach that to the frame. Well, there's a lot of inefficiencies that Sandy Munro and his crew was talking to them. So what they're doing now is they're going to take a unibody construction, one big aluminum frame. I think it was aluminum, but they're going to make that part of the frame itself. And what they're going to do is they're going to take these larger size batteries, put them on this like a baking plate, and then fill all the innards with epoxy so that you get this one rigid plate. And Sandy said, man, if you drive that thing off a cliff into a canyon or get hit by a train, the wheels may fall off your car, but that battery pack, that integrated solution, is still going to be there. And he said, hey, that thing's going to be around forever. Your kids will be able to power their starships with that. And so that looks something like a 50% reduction in weight, which is everything. And he compared that to Lucid, who is in the business to, compete, and says they're a lot of talk. They have some of the former Tesla engineers, but they got no cars on the road. Now, allegedly, they claim that their motors are as good as anybody's, but haven't seen them yet, and they haven't sent them to Sandy Munro for reverse engineering. But they are making some claims also that they're going to get state-of-the-art friction reduction from the shell of the car, and that they're going to get an advantage over Tesla in the aerodynamics and so forth. Right, and that's a big claim for, going against Tesla, which just, as part of their partnership with SpaceX, just successfully delivered guys to the space station. So they know something about aerodynamics. And then Nikola Motors, which we've been tracking, just signed a $2 billion contract with GM. That's almost always the kiss of death, in order to produce a truck. And there's a semi. And there is some concern in the industry about the little promo videos that they did, was that they made it look like it was rolling along a flat piece of desert when it was just rolling downhill without an engine in it. So there's some skullduggery with Nikola. So the two really significant challenges to Tesla don't have anything like yet proven technology. And this improvement from old style battery to the new battery announced during the battery day at Tesla has Sandy Munro absolutely satisfied and excited. And if you can achieve that, that's a data point of one, but that's the data point that matters. And so I bought a bunch of Tesla at 380 for me and the kids, and I will never sell those. So this one here, the end of the industrial or internal combustion engine as we know it, which to me is why all the stars are in alignment for Middle East peace. So if you look at the Trump administration's remarkable successes in the Middle East peace, I think it's because of this, not because they're necessarily good deal makers. It's just that, part of being a good deal maker is being there in the room and being open to the possibility, in the same way that we look at Ken Hum's trade here. He's open to the possibility. And when you own all the oil and people must have oil, you can be a prick. But if there's realistic alternatives, suddenly nobody cares about you at all. And nobody cares if you're going to bomb yourself back into the Stone Age, because we don't have to care. And in the world of international relations and survival of the fittest, welcome to the world. So there's some possibilities in the Middle East that are happening. And there's some possibilities in North Korea, where Kim Jong-un is probably dead. And against all odds, the Trump administration has kind of improved relations in that area. And so if you can get past the rhetoric and the hype, there's some really interesting things going on that are well postured. And I talked about this last night, that there's some evidence that when you take a look at the blended monthly rebalancing, so last night's video, I think, had some interesting comments on it. So from 20200926, which is uploading as we speak at YouTube. Tech and consumer discretionary remain in play. But there was a move away from EEM, which had been the best non-U.S. performing sector, and that was moving towards I'm sorry, this should have been SPY. So it was the large caps and tech, but this is moving more towards XLY and XLB, which was materials and consumer discretion. So there's like a shift back towards the U.S. And so it may be that as we're approaching the big election, and now we're 40 days away, this whole period of time from about 100 days to 40 days, this was filled with chaos. And we've seen that, what was a minus 11% sell-off in here. And so as this becomes closer and closer, the amount of chaos to contend with, there's probably a lot of noise. But as people start looking at your real choices, Biden versus Trump, and you realize this is the status quo if he wins, and log jams, and it looks like the Supreme Court will be taken off the table. So if that's the status quo, and then this is only the possibilities of goodness in a second term based on this kind of action, the North Korea and Middle East, and at some point COVID's going to run its course, either by nature or whatever, then this could account for some of the shift back towards the U.S. So as we come out of the election shenanigans, we start looking at January and going forward, isn't it still really the U.S.? And then isn't it the large cap techs? And isn't that going to be Tesla? So that makes our little study of the TQQs versus the TECLs to be of interest. That's the triple techs. And then meanwhile, we've just been watching the cycle between XLB, XLE, XLF as the cycling is going on. And sector rotating plus techs is sort of a strategy to adopt for the next 6 months, having a baseline of careful techs, with core and turbo, and then the other three, B, E, and F, cycling in a second component. So playing the rotation in here, and then playing core and turbo on tech seems to be what's emerging for me. And then when you have the market plus the sector plus the that outer ring of companies that are well positioned, that seems to be a reasonable way to approach hybrid trading with this core strategy. So I can see that for being the case for about the next 6 months for sure, to get us through the elections and then 1 January. Yeah. All right, so Ken Hum asked a question last night, and it was about calculating R. And this leads to some interesting discussions for like this morning's lesson. There were no questions in the hybrid workshop, so I'm just going to drive on with this one. And so I'm going to come back and say how I might apply it in this standard looking trade. So calculating R for your histogram so you can make some analysis. Here's why isolating on calculating R makes a difference. And it's going to start with a swing trade story. So as I started moving more from just weekly rebalancing towards more of the structured swing trading in the late 1990s and the early years of the 2000s, what we were getting is when you came out of the internet bubble, there were some big long trends that were happening. And then somewhere around like 2003 to about 2007, what you had was more of a cycling market. And it was just enough so that if you were trying to get these long-term trends, something would emerge and try that, it would fail just in time, and it was like kryptonite to long-term buy and hold, or I should say trend following. And so in this period of time, structured pattern swing trading was very effective. You could just come up with a set of rules that were geared towards the behavior of price action in this window, and that really worked well. And so from that, we developed the mechanical swing trading, the course, and the systems. And it featured things like 5 days down, 551W, triple screen, channeling, overreaction, and washout. And most of those were well suited for bull markets, whether that was a long, straight, grinding bull or whether it was generally a bull but was cycling. The washout was the anomaly in the sense that it looked at something that was horrible but had made some hint that it was turning. And in some ways, that's the conceptual predecessor of the supported spring crossing. So these mechanical swings were working really well and still work well. when I started looking at the histogram of performance, and it was positive expectancy, that was good. So I started doing the analysis of the histogram to see, is there a way to reduce some of the losses, and am I open to enough of the gains? And so we developed this thing called the trade log analyzer, or actually the trade index analyzer. And what it was going to do was to take a look at the members of that histogram, that long trade log, and ask the question, how well are we really doing in this area? So you can take the position that, you know, the market is this complex adaptive thing, and that there's a time when you're stalking, then there's a time when you've entered the trade, to the time when you've exited the trade. So you've gone from entry to exit, then you're stalking again. So you're in the market, you're out of the market. And what would happen is this, you know, you can think this thing is like this tornado just swirling around, and then some little window of opportunity opens up and says, hey, there's this pattern that you like in this one sector, segment, or member of the market, which triggers one of these mechanical rule sets, and so then you can execute the rule. But because the market is so dynamic, we could say, are the conditions that made this a good idea still in play, or has the market itself moved and adapted so that there's not a good alignment between your rule set and the market? So what we really care about is how well aligned are the rules to the broad market opportunity. So adapting some ideas from Chuck LeBeau, we said, look, well, if I entered here and then I had some trade that lasted for time t, and then I exited here, Chuck's idea was go out to the 2t time frame, and then in this whole period of time, so if I got, let me say, if I entered at this price level and I exited here, well, you could see that I had made, oops, let me get a better color there. I would have made this much gain. So in Chuck's idea, you would go out and look in the 2t time frame and say, what was the best possible price in the 2t time frame? And then you could say, well, if I had had perfect insight, this is the best exit I could have had. And so this was the amount of gains that were left on the table, because I got this, but I didn't get that. So I looked at this and said, well, I'm also interested. What I'm really interested in is in the entire 2t time frame, where was that excellent price? Was the best possible price inside the 2t time frame? So I already saw it, but then because of reasons, you know, my maximum favorable excursion, did I already see it? And then my rules for staying in allowed me to give back that much. So how much was I giving back from my maximum favorable excursion compared to the gains that I was giving? So there's a certain trade efficiency there. So was that happening in the T or in the 2T time frame? In other words, if I looked at a histogram and analyzed all the individual components of that, I might say, hey, what if 60% of the time the excellent price was happening after I exited, and only 40% of the time was it happening here? That might tell me, hey, look to maybe tighten up some of these rules about don't give back so much. But if 100% of those things were happening after here, maybe I'm just getting out too soon, and that I need a way. I need a way to re-enter, because there's another bigger, better opportunity in the second time frame. So the other thing that I was interested in is, well, I've got some 1R price level here, a minus 1R, my execution R, which says I'm looking this way. But I'm also interested, what was the worst move in that 2T time frame? Because in this case, my exit allowed me to capture this little piece, and my 1R loss keeps me from experiencing anything down in here. But I also want to know that if I've got a rule set that puts me into a critical state and there's some amazing move available in either direction, and I take it in one direction, how much room was there on the downside, let's say, that I didn't get? So the basic structure of the trade index analyzer was to say, if I just take the time of entry to the time of my actual trade, time T, and I just go out to 2T, I can now map my actual trade from the price of entry to, let's just call this here the exit, and still keep my little 1R in here. And then I can find the maximum favorable excursion, and then the maximum adverse excursion. And now I can set the maximum adverse excursion to 0 and the maximum favorable excursion to 100. And now I can divide this into like a thermometer scale. And now I can map my actual entry. So let's say this was at $20 and this was at $10, and I entered at 16. When you do the math, that's an actual index value of 80. I think that's right. Let's see. No, 60. Duh. Because I'm 60% of the way up the stack. And then if I exited at 18, if I exited up here at 18, that's 20 index points that I captured, because an index value would be 80 for a price that was on 18 between a scale of, between 10 and 20, a score of 18 would give me index value of 80. So what I actually captured was a normalized 20 index points out of the total available move of 100. So the efficiency on that is only 20%. That of the move that was reasonably available in whatever time frame and whatever market conditions that my little pattern told me was, hey, that you could trade it in that direction under these rules. If that trade only scored 20%, then that's telling me, in this case, man, there was an amazing move to the downside. Yeah, and your exit capital preservation stop protected you against taking a loss on the long side trade. But dude, there was a move somewhere from 80 to 0 or 0 to 80, depending on where the low occurred. If the low was in the second half and happened after, there was a move down to here that was available, like on a stop and reverse, that could have been worth 50 index points or 2.5 times better than the trade you actually got. Now, if you get enough trades in your positive expectancy and you take a look at your histogram, you're measuring what is actually there, and you say, hey, I'm really happy. That's positive expectancy. But you may be missing the larger opportunities. You're consistently picking up nickels, but avoiding the silver dollars that are reasonably in that proximity. The other thing I was interested in looking at was where on average is my entry hitting on that index. I'd be really happy if I was, basically trading long and my entries are very close to the bottom of the move in the 2T and I'm getting some kind of positive expectancy move. That would be great. And then if the low was occurring down in here, but not after my exit, then I was getting really the directional move that was available. And maybe if that really good move is in the front half, this is a really efficient trade pattern because I'm entering at a critical state where it's low. I'm getting most of the move that is actually happening in front of my eyes, and the residue that's available in 2T isn't really there. So I'm actually being very efficient on capturing the window of opportunity that's there. So this trade index analyzer was a way to start looking not at what was on the histogram, but to look at the region around the histogram to see what else might be reasonably there. So I took this great big long set of many hundreds of swing trades, entry, exit, how long in the trade, start, all that stuff, and subjected it to this trade index analyzer. And what I found was like on the 5DD, I was capturing like from 44 to 50. So I was getting these tiny little pieces. And what I was missing was this great big opportunity on the downside. And there were a lot of follow-on moves. Like if I was only capturing 6 index points in here, there was still 44 or 50 available to the upside. And then there were big moves on the downside too. And when I looked at the other mechanical swing patterns, it became clear to me that even though those were very, very satisfying and had great SQNs, the SQNs were good at anywhere from like 3 to 5. I said what I needed to do was to develop a continuation pattern, because I would take the first 5-day down pattern, trade it long, get my exit, and be happy. But what was happening was that little 5DD down would lead to a longer term pattern of successive gains, and I was getting that first move and then missing the entire move here because it didn't happen to have 5 days down. And so I was missing all these. But if I had a relaxed continuation pattern, if that first pattern fired and was successful, and I got a universal entry and it never violated that original stop on the very first pattern, that I could start playing these and just with universal entries and re-entries, and I could start getting sometimes 5 to 7 additional series of trades all the way up. So the continuation pattern became very important. And so that became a module, which we put in that TradeStation code deck there. So we now have the mechanical swing patterns plus the continuation pattern, which simply is a bolt-on module that you can add to every one of these mechanical patterns. So the mechanical pattern plus the continuation pattern turns out to be a way to extend the value of those moves, so that when you do get these grinding moves like were happening in here, you can actually get more. The second thing that we noticed was that when there was these large moves to the downside that our protective stop was avoiding, but we weren't exploiting. And so then that led to the failure module. So we could say you could have 5DD, you could have a 5DD continuation, and then you could have a 5DD failure. So now we had a broader repertoire, and each one of these can be mechanically coded and framed. But what this started to develop in my mind was if these mechanical rules were the systems, then a more relaxed way of trading all of these patterns could be a strategy. All right. So what I wanted to do then was find a way to, how do I mix and match those? Because now I have 6 systems, but now I have 12 because there's a system plus a continuation, and now I have 18 because I have a continuation and I have a failure, and I have, which is the best set of those to specialize in? So now when I start thinking about calculating R, one of the things that I can do is I can say, let me look at the 5DD, and then just the 5DD continuation, and then just the 5DD failure, and then I could compute a system quality number and performance data for each one of those as a separate one. Because let's just suppose some world in which the 5DD continuation was so good that it was so much better than the regular or the failure that all I might want to do is just trade that one and then use the 5DD simply as an entry or a screening criteria to alert me to start taking all of the, and I could specialize in that. Or maybe it's the failures. Well, it turns out that in a bear market, the failure modules of all of these are really good, as you might expect. Things are going down, and that's the direction to go. It turns out that the meta system, in which you just take all of those in a relaxed way, is really, they're all good enough to trade. And so you can get a meta system where you say the 5DD family is worthwhile trading and not worry so much about which one happens to be working. Because there was enough variation in the market conditions that sometimes the 5DD was the one, sometimes the continuation patterns were the one, and sometimes it was the failure. And so if you only decided to pick one, then you would miss the opportunities when it turned out that, hey, it's the 5DD is now in phase. Or no, now it's the 5DDC is now in phase, and that's the one. So to account for those, the idea of how to calculate R really does kind of matter. So I want to just talk about the trade index analyzer is a way that you can take your existing trades. This works best for the swing trades, and then just see what kind of performance or what kind of opportunities are you missing. What that allows you to do is then you can say, I'm in this trade with my rule set, but now I can start looking at the region around my particular rule set to see maybe if I extend my rule sets or add another module, I can start capturing more of what's available from this dynamic market. So, save that just in case I need to ever redraw that again. That's so far so good, guys. You hanging with me there? Now, why study R? Why not just study the money? And the reason for that has to do with scale and prototype mentality and psychology. That if you're always trading at production size and you have a new idea, if you start trading that new idea at production size before you've you've sorted it out, then there's really, you're trading at a size with maximum anxiety. So one of the reasons to map it up, to abstract it just to R, is so that you can look at the, at the R, what I am calling now the R capture. And even if you're trading it, like with my advice about trading things with one share, now you have, this is the best trade simulator of all. Hey, Ken, you got a really good trade simulator idea? Yeah, trade the market with one share. Is there a better simulator than that? No, there isn't. There can't be. The best model of a cat is another cat. And then preferably the same cat. So if you forward traded with one share, you have the best possible simulator of all. You don't have to worry about, does the simulator accurately reflect the real world? You're trading the real world, but with one share, and now you have skin in the game, and you can see how the actual performance happens with your broker, and they keep score for you. I mean, how good is that? You don't have to worry about how good is the underlying simulator model, and are they accounting for slippage realistically and all that. You're using the best possible simulator. So the idea of studying R is then, when you understand how the pattern works, reward versus risk, you have your estimate of what you think that pattern will do, and you think, what kind of reward can I get and what kind of risk can I manage, and then you get the results, and then you can compare actual performance back to your estimate, and you can say, are the rules that I'm using to frame this trade and to understand the possibilities, are they reflected in the actual performance that I get? And then you can use this idea of the trade index analyzer to say, if my rule sets are trading between time 0 and T1 when I exit, and I'm getting this, what's happening in the larger time frame, and how well is my trade frame estimating not only what I'm seeing here, but also the reasonable proximity, above and below. So, and by analyzing for R, and by abstracting it to this 0 to 100 scale of maximum favorable excursion to maximum adverse excursion, you're now getting to see, hey, which part of the curve are my rules actually getting? Now, sometimes, like on a 5DD pattern, this trade may only last 1, 2, 3, 4 days. So you're going to go out and look at the 8 days. But if it was only 1 day, you're only looking out at 2 days. And the reason that is probably a good idea is that, however nervous in the service you were, and you were exiting at 1 day, it's not fair to compare that out to 10 days, because the mindset that it takes to manage 9 overnight risks is different than the mindset that you were operating under here, where you captured the price. So this idea of T and 2T is a fair way to evaluate the impact on your psychology. Well, what if I had a 5DD, and I had some trades that were only lasting 1 day and some trades that were lasting 10 days? This whole idea of T and 2T now allows you, by scaling this between 0 and 100, it allows you to take these index scores and dump all of these 5DDs into a large database, and then plot that as your index. So it kind of normalizes it and accounts for the different periods of time. It accounts for the psychologies that you're under. And that's why you want to study R, is because you de-link it from the psychology of particular money management, and now you can make a decision about when to when to experiment with one share, when to test, when to prototype, when to do limited rate production, which is maybe half size, up to full size. So maybe this is one share, maybe that's, you call it whatever you want, 10 shares, maybe a prototype, you're at 1/10 of your size. So you just figure out what that is. Now you have the ability to start scaling towards production all the time using a standard metric of R that's not being influenced by the size of the position, which makes you want to violate the rules, which means that you're not testing the same pattern, that you're letting your psychology of money get in the way of an effective test. So this manufacturing process of how to go from an interesting idea to experiment, test, prototype, limited rate production size allows you to scale always on the basis of understanding what R does. Once you get out here into production, it turns out that the dollar value is probably more important to you than the subtle nuances of the R captures. Although you can still use the R capture to influence this. At some point, when you have that under control and you're satisfied with where you are, you can start making more decisions on the basis of direct asset allocation, and that's because you will have internalized. By the time you're doing that, you have taken this particular pattern or your rule set, and instead of, if this is yourself, instead of thinking about it as some kind of external, while you're in this experiment, test, prototype, limited rate production, that thing is moving closer and closer to where you've internalized it. Once you brought it inside your repertoire, inside your professional space, then you're at least at limited rate or production size. You're no longer treating this at arm's length as a risky thing. You say, no, I have enough confidence, I'm bringing it into my skill stack. And so how you gather evidence during this period about when to bring it up the scale of production matters. By the time you've got it into production, you've satisfied yourself 2 or 3 or 4 times that this thing is reliable enough that you can really trust it and trust your judgment, and then you can concentrate on the dollars. So I say all that simply to get back to the point of the case study about how to calculate R. So the question remains, how to calc R in this case? And so I will say again, it depends. What is your purpose? And what's your posture? I'm going to say, where are you in this scale decision, between experiment, testing, prototype, limited rate, and full production? So where you are in there is going to influence the answer of how to calculate the R. Because if I am really relaxed and I've internalized this and I'm using a strategic approach and I'm just going to take here's a Z3P breakout with a PSAR risk box in the usual way, and here was a up, down, it held support inside the dragon, the PSAR never flinched, and so I'm buying the pocket before or at the RL10 breakout. This is probably like an emerging dragon and then I got some kind of sniper exit, and then I have the manager exit at the Bollinger Band mean. Maybe this is so routine to me that all I really care is what was the series. It started with the Z3P, and then the trade happened, and then I followed a bunch of optional rules and discretionary rules, but I'm trading in that particular style that is so comfortable to me. All I really care about is when I use this style or this strategy in general, what kind of R do I get? That's one way. If I was looking at this thing systematically, I might be saying specifically, I want to know just the performance of the initial Z3P, and I want to know specifically just the performance of the Z3P. Let's call that a continuation, or maybe in your mode that might be a supported summer crossing, because if we looked at this, we'd see that was a supported summer crossing. And I want to know what the individual contribution of just the Z3Ps are. And I'm going to collect a bunch of data from a bunch of trades, and then I'm going to separately do the supported summer crossings, and I'm just going to isolate those so that I can decide what the expectancy of this is and the expectancy of this is, case 1 and case 2, and then I can make a decision. Should I just trade Z3P? Should I just trade supported summer crossing? Or should I trade them together as part of a series? Because remember, supported summer crossing could happen even if that wasn't a Z3P. That could have been a supported spring crossing and then a supported summer crossing. So the supported summer crossing has its own value. But a Z3 pinch breakout to a supported summer crossing, that supported summer crossing is a function of the supported summer crossing and not so much what the initial condition was. So there's a reason why I might want to just study Z3P. Maybe I want to just concentrate on Z3P. Maybe I want to concentrate just on summer supported spring crossing, but maybe I always want to do the continuation pattern, regardless of which one of these starts. So the way I analyze these trades in a large histogram now intraday matters, because now I can decide which one of these initial signal generators do I want to use, and do I want to follow these. Now, in my actual recommendation in my practice, these two things are not simultaneous in the world because of pinch and stretch. Like, it is rare for you on a single instrument. You're never going to see a single instrument that is both of those. Those are two different times in its life. Supported spring crossing happens when there was a horrible sell-off, that slowly got better, and then you decided to get in. So there was already a big directional move that was happening, which then gave you an opportunity to buy at an extreme. A Z3P happens when price has gotten volatile and then closed up so much that the absence of volatility is what creates the opportunity for a breakout. So one symbol is not going to have both of those. You're going to see the supported spring crossing over in here, and you're going to see the Z3Ps over here. But you might see a continuation pattern that came out of a successful one here, and you might see a successful continuation pattern that happened after this first one. So the continuation pattern, that buying on dips, has a kind of like a universal quality to it. The reason you might want to specialize, though, is you say, I'm not just trading one symbol, I'm trading a stack of 5 or 10 symbols, and some of them are looking like supported spring crossing because they're very volatile, and some of them are looking like this Z3 the Z3P, where it's very, very quiet. And you might decide, which part of the stack do I want to trade? I just want to concentrate on the ones that are already volatile, or no, I want to concentrate on the ones that are abnormally quiet. And that's a matter of style and preference. So you might want to actually compare the performance of Z3Ps and supported spring crossings, and then decide, once I'm locked into that trade, I'm going to take those second positions whenever I can, as a general rule of thumb, because I'm already well started. So that's where this thing can go to. That's why deciding how to calculate R really depends on the question you're trying to answer. What's your purpose for asking the question? And what kind of posture is your trading in, and where are you inside the scale? And are you trying to pick which one of these to get started with? And then are you trying to decide, is the continuation pattern also worthwhile, or should I just play the first trade and quit squirreling around and just take as many of these as I can, and when it's over, and just go back and reset to the start and not worry about the continuation? So I'm going to tell you how to calculate R is going to be a function. The more important question is, what is the research question? What is the purpose of asking the question? What's your posture, and where are you in the scaling of, and what are the real choices that you see? So if you work through those, you're going to be in good shape, okay? I feel like I'm at the point where the kids would say, Dad, we just want to know what time it is. You're teaching us how to build a watch. And they'd be right. So now I feel like I can just answer the question, because I've warned you. So I would just say that in this case, if you compute the average R for every little transaction in here, if you compute the average R for every transaction, you're going to be okay. So trade number one, I'm going to call this entry at, I'm going to clean this up just a little bit. So entered at 72.45, had an initial risk of, let's just call that 72.20. So the I stop was 0.25. And this one, trade number two, entered at, I'm going to call that 73.20, just to keep the numbers even multiples. And so this was at a probably, I call that 72.95, also 0.25. Here's one of the reasons why you like standard risk boxes. It now makes the R capture much easier, and you're going to have standard position sizes later on in production, so you're going to like that. But in this case, if this was like 0.17 and you're studying you're early in the research age, you say, hey, that's exactly where I'm going to put my risk. You actually want to use the very precise measure so you can see what the R capture really is, instead of rounding it off for production. There are things that you do in the theory and the study that don't translate as well into production and practice. So those are some trade-off decisions you make in manufacturing. So you can design things, but then when it comes to actually implementing in manufacturing, you may want to make some changes. Like I was studying last night, in the sense that I was listening to it, Phillips head screwdrivers. And there was a guy in Canada, Robertson, who had made a different variation of it. And in the Model T Ford, he said he signed a contract with Henry Ford in the Model T for 700. They had 700 different screws that were fastening the body together. And by using this guy's improved screw, they were saving $2.50 per car at a time when the car was costing $250. So just by adopting a better screw, they were saving a 1% margin. That's unbelievable. Okay. So in this case, if I didn't take the second trade and I adopted a sniper exit and the managerial exit, and the sniper exit is at 73.30 and the sniper exit is at, I'm going to call that 73.10. Trade number 1A, enters at 72.45 and exits at the sniper at 73.30. And so that's a capture of 85 cents over 25 cents, which gives you 3.4 R. 1B enters at 73.20. 73.20, exits at, what did I say, 73.30. So that's 10 cents over 25, and that gives you 0.4. So the average exit between 73.30. Oh, I'm sorry. No, it was I'm sorry, 73.10. I'm sorry, 73.10 was minus. No, that's not right. 73. Stupid. Trade B was, I'm sorry, I got the start point right. 72.45, exits at 73.10. So that's 0.65 over 0.25 is 2.4. So that trade equally split has a 3.4 and a 2.4. So that averages to 2.9. So you could say this trade, so trade 1 as a series earns me 2.9 because the blend of those two positions gives me an average exit, which works out to 2.9. But if I was trying to decide what the sniper versus the manager was, I would treat that as two separate trades, A and B, and say the sniper gives me 3.4 and the manager gives me 2.4. So now I have three choices. Do I take them? Do I just want to always use the mix and be settled for 2.9? Or do I always want to just take the sniper? Because there are times, I will tell you, when the manager exit is better than the sniper exit. Like if you had a trade that went up here and the sniper got you out here, but the manager didn't get you out and you didn't re-enter and this thing just resumed, then the manager exit got you out up here. There's a case where that manager gets you 5 and the sniper got you 3. So when you do that sniper versus manager versus sniper plus manager, you now have 3 conditions to consider just on the initial trade. That's worth doing. Once you're satisfied with that, as a separate research question, you can make a decision on whether to use it. So I've done that. And for me, just treating this as one trade with the Wu Wei exit is the way to proceed because it simplifies my life, it simplifies my accounting, and at the end of the day, that's going to be good enough and I'm willing to live with it. but that's because I'm trading a lot, and I don't want to spend a lot of cognitive time trying to, is this the time when I should just use the sniper? Is this the time when I should just use the manager? I just split the difference and take the average. You know, the simplified way to do that for you is just treat it as two trades. One of them with the sniper, one of them with the manager. And if you code that 1A and 1B, you can just study, what does the manager give me? What does the sniper give me? And then after you accumulate 30 to 100 trades, you can decide, do I want just the sniper? Do I want just the manager? Or do I want the sniper and manager? So that's how you get there. Now, I'm just going to consider this trade. If I looked at this just as this trade and I'm using the Wu Wei exit, I actually don't even get out to here, and then that's just a -1R. The reason you would exit here or exit here in this trade was, hey, because of reasons, I had a chance that I saw it gave back that much, and I just wanted to make bank. And the reason I would do that is because I started after the first leg was up, so my willingness to harvest the first piece is reasonable. Whereas on the first move, I'm willing to let this thing last longer because it has a chance for the first good strong move. But if I've already seen the first good strong move and I'm only thinking there's 3 moves and the first one's already off the table, now on the second one, which should be less powerful than the first move, I am more likely to capture a small gain than I am on the first one, where I can afford to let it run because of the potential payoff. So now you can see how complicated that idea of just trading the second position only really is. It makes more sense to me to trade it in the context of, hey, I'm trying to get a second position on in case this thing becomes a big win, where it was up, pull back, and then gets the big win. And now, boom, I got my second position in fast. I get my stop to no lose plus dinner for 2 on 2 positions. And now if this is a big win, it's a big win. Now, if I am now going to try to calculate the R on both of those, I would calculate the first trade with the 2 exits and then the average exit. And then the second trade, I would then just attribute half the position to the first exit and half the position to the second exit. What you really get when you do that is, if I just take my entries on both of those, and if my position size is standard, which is my advice, and if the risk box is standard on both, which is my advice, then you can take the average entry and you can take the average exit, and then now you have 2 times the average trade. And all you got to do is just compute the average exit, the average entry, compared to the average risk box. So that gives you the average win, or average gain, I should say, because it might be a loss, versus the standard risk. And then it's just the number of trades you took. Why does that work? Because I might have the case where I got the first position, a second position, I took an exit, then I got a re-entry, and then I took an exit. And so now I have this whole series of R captures on one sequence, and I just want to know what was out of that whole sequence, what was the number of trades I took with the standard risk, and what was my total number of dollars per share captured, and just roll that into an average win divided by standard risk box divided by the number of trades. And that'll give you an expedited way to capture the R value, the expectancy of that whole strategy. Otherwise, you got to get into the position of just study this entry, just study that entry, just study this exit, just study that exit, and then study the blended exit. It's worthwhile when you're learning the kata number 1, supported spring crossing, study the sniper, study the manager, and then make a decision on whether or not just to adopt the Wu Wei effortless action. In the long run, the Wu Wei exit, I think, is where you end up, because the cognitive effort is so easy that you don't have any stress about which one of these should I use. I just take half with the sniper, half with the dang manager. Once I get to the second trade in, half with the sniper, half with the manager resolves all of the internal psychological construct or psychological suffering that you do. I'm just going to leave it there because I feel like any further explanations are just going to muddle this up for you. So Louise says, I want to know R to define initial stop, risk, standardized trade size, be able to. Yeah, so yeah, that's correct. You want to know the R, which comes from the R is the initial risk. The initial R is the price that disproves the trade hypothesis, right? So when I take this Z3 pinch trade and I accept the PSAR as the initial risk, what I'm saying is that the hypothesis of this trade is that the move out of that Z3 pinch condition more often than not is going to reward me over time, that the multiple wins of risk that I get up in here, whether this is a stop or this is the stop or that is the stop, any reasonable exit strategy means that the gains that I make compared to the risk that I take gives me positive expectancy. So this price here, the breaking of the PSAR, tells me that this thing, with enough confidence, that hypothesis is not happening. It's this. So trade hypothesis over. So I pick my risk, which says what price tells me that this pattern is not working in that direction. That is one execution risk. 5 times that is the legitimate position sizing risk. So when I'm deciding how many shares I can actually buy, I set that equal to a 0.2 R. So if this one gained 1, 2, 3, and then exited, then I have 3 gains of 0.2. That's going to end up being a 0.6 position sizing R win once I get out into production. Okay? Yeah. Okay. You're responding to the earlier question. So that's everything I wanted to cover on this trade example. So just to summarize on a blank screen. So trade number one with a standard risk went to the sniper with half, and the other one went to the manager. I would treat that as 1A and 1B because they shared exactly the same start point. And now, by understanding the sniper and the managerial exit, you can then start comparing those to see which one of those is more favorable to you. And then what you may end up discovering is what I concluded, that over the long run, if you take one half of the sniper and one half at the manager, that you can just treat this as one series with a finesse that reduces psychological stress. If you reduce psychological stress, you reduce cognitive effort. Reducing cognitive effort makes things easy. You have a great big easy button that you can push. You want things to be easy. Why? So that you can do more of them and not worry about the individual trade. Just do that first. Once you do that, you can then study your second trade. And again, by the time you put your second trade on, you probably have the sniper and manager exit. And then you just say, all right, what's the value of adding the second trade? If that second entry doesn't really work, this thing more often than not is just going to, you look at where the second trade enters and you look at the average exit. When that doesn't follow through, the second trade is almost always a scratch, that the entry is so close to the average exit that the second trade isn't even a factor, and there's no harm. What that means is, if it really had worked, you'd have two scoops going up, but if it didn't work, the second trade didn't matter, and you get paid by taking the first initial risk. That's where you end up when you do it this way. And then once you can get this second trade, the entire series, if this was my initial risk, once I can get, and this was my second entry, once I can get my stop for the entire position above my second entry, then I'm good to go. Because now I have two positions and I've locked in a really solid gain on the first position, plus the second position is in the money. And now it's just a science project. You'll see me try to get that second position on quickly. And then if it doesn't work, bang, I'm out. But if it does work and I get my no lose plus dinner for two on the second position, dude, there is no psychological stress on me at all on that one. It's now just going to be it's just a science project. Okay, so that's everything I wanted to cover there. So Luis asks, I remember a stop and reverse in EWW out of a pinch that yielded multiple R's. In that case, I stop was not at the bottom, but something else. Yeah, that's an advanced technique in the hybrid system. So if you have a Z3 super pinch and this thing breaks out and starts going, this stop may have been at the Bollinger Band mean, it may have been at the Z3, But when I bring this up to here, if this thing starts rolling over, that stop and reverse happens here at the edge of the previous Z3, so that this first one is a scratch, and now I'm short, and I'm playing for the short across the channel, and then if it breaks out of this channel and starts going, now I've locked in on this one. So this one, on that Z3 pinch, after about 4 or 5 bars on the Z3 pinch, my stop should be up here at the former channel. So I'm not even going to tolerate losing money on that trade, because now this looks like a fake breakout and it's going to go that way. This is called the fake one, go to technique. So you have this long sideways channel, and sometimes you take the first breakout because sometimes it just breaks out, but other times it'll give you a false breakout this way and then really go. So you try this short because you don't know, but then it comes back and didn't follow through, so you stop and reverse, you capture this, and then that thing really goes. That's fake one, go to. And that comes out of the Z3 pinch or the super pinch. That's a special case of advanced hybrid intraday trading. That's why the course is powerful, because that's a really good pattern. That's why I love Z3 pinch, and I love the super pinch. Those don't happen often enough that I just want to wait for those. But when they do come around, usually around lunchtime, I'm ready to go. Okay, so there we are. That's everything I got. I got to run over the soccer field. I'm running a little bit late. So take good care, guys. That's everything I got for us today. That's today's lesson. Ken Hum, let me know when you hear this if that was that answered your questions. Good to see you this morning, Bob. Good coffee. Take good care.